This is the Asia Trade. I'm Shery in Tokyo alongside Haidi Stroud-Watts in Sydney. The top stories this hour. Wall Street looks beyond big tech in a countdown to the Fed as traders seem split on how big the Fed's rate cut might be. Intel jumps after announcing it will make custom AI chips for Amazon in a multi-year, multi-billion-dollar framework. Plus, we hear exclusively from the New York Stock Exchange Group on the state of the IPO market and its growing focus on Asia. We still have a few markets away on holidays for the Asian session, including mainland China and South Korea. But take a look at the setup right now because we're seeing Nikkei futures pointing to the upside. Of course, we're coming back from holidays after we saw the Japanese yen really strengthen overnight. Right now, seeing a little bit of downside pressure against the U.S. dollar, but we're talking about really passing that 140 per dollar level at one point on Monday. We're talking about the world's top performer this quarter already. The ASX 200 futures pointing to the upside as well. We had 3 sessions of gains already. We'll see if those gains continue given what we saw in the overnight session. We saw slight gains in U.S. markets. Take a look at how U.S. futures are coming online. We had the S&P 500 mildly higher, but take away the big mega cap names in the tech sector and you're actually going to get the S&P 500 touching a record high. So we had Apple leading the losses. We had an analyst warning that demand for the iPhone 16 Pro has been lower than expected. But when it came to the banks, we saw actually them outperform. And this coming at a time, of course, when people are thinking perhaps we could manage that soft economic landing. Treasuries continue to rally. We had the 2-year yield near the lowest in September 2022, and really all to do with where the Fed goes from here and whether we're going to see that 25 or 50 basis point cut. But of course, we're following what's happening in the political scene as well, especially in the U.S., with former President Donald Trump now looking to capitalize on the second attempt on his life in recent months. Sources tell us that Trump will continue his campaign schedule this week, just 50 days out from Election Day. Political news director for Bloomberg TV and radio, Jody Schneider, joins us now with more. And Jody, really seeing this political violence unfold in the U.S. has been stunning, but we're now hearing from the former president about what he says is perhaps this violence promoted by his opponent, Kamala Harris and Joe Biden.
Yeah, we heard from former president today, Shery, who made that very argument. He was looking to sort of reset his campaign, if you will. Since that debate last week, they've had a fair number of missteps, including this rhetoric about migrants eating animals in Ohio. He's got into a feud with Taylor Swift over her endorsement of Kamala Harris, and J.D. Vance had a bad showing of the Sunday shows yesterday. And then when this attempted assassination, as the FBI is calling it, occurred, it really gave the former president a chance to kind of try to reset, to really to proclaim himself as a fighter, a survivor, someone who's now survived 2 assassination attempts. He says he's going on the campaign trail. He's not going to stop. And he laid blame for this attack or this attempted shooting on his opponents, saying that their rhetoric was to blame for this. They were creating this cycle. Now, of course, there's no evidence, and he didn't point to any particular evidence for that. For their part, the former vice president, who is the campaign at the top of the ticket for the presidential campaign for the Democrats, and the sitting president Joe Biden have come out and condemned violence. Right after the shooting, they came out and said there's no place for political violence in America. So we don't know quite where he's, what he's pointing to here, but he's clearly trying to paint a picture of himself as a survivor, as somebody who will fight despite these attempts. And we'll see if this is something that is a winning strategy. We have not seen polling yet since this assassination attempt on Sunday, but given it's only a day ago. But after the debate, even though Vice President Harris was widely viewed as the winner, the polls didn't change that much. They're both going after a very narrow sliver of undecided voters.
Yeah, we're still trying to figure out what the fallout will be from Sunday's events, but do we have any indications of immediate changes that could occur around the campaigning, around the two candidates at this point?
It really doesn't look like it, Shery. We've heard from the former president saying he's still going out there on the campaign trail. He has campaign events scheduled for most of this week. And we also heard from the Harris campaign that they're going out on the campaign trail. Neither side is really changing their plans. Again, the swing states are so key here. Places like Pennsylvania and Michigan and North Carolina, where the candidates are kind of crisscrossing. This is where those electoral votes will really be claimed. And both candidates really realize the need for that. So we don't think there's going to be a whole lot of change in this. We will also hear from, I'm certain that there will be investigations, perhaps hearings on Capitol Hill about Secret Service protection and whether that needs to be changed. Although we did hear from a fair number of experts today who said it is very hard to secure open spaces like golf courses. But I'm sure that we'll be hearing much more about this and how this the suspect in this case, who has been arrested and charged, was able to get 300 to 500 feet away from that golf course where the former president was on the golf course with a security detail. But again, how he got so close and how he had been there for some time without being seen.
Political news director for Bloomberg TV and radio, Jody Schneider there. And of course, political developments, just one of those factors that investors have to keep an eye on this week. Haidi, we're talking about the 36-hour window when it comes to central bank decisions. And of course, everything starts and ends sort of with the Federal Reserve, and really so much doubt right now over where they're headed. Are we going to see a 25 basis point cut? Are we going to see a 50 basis point cut? We haven't seen this amount of skepticism and doubt in swap markets for any scheduled U.S. central bank decision since 2007.
Yeah, that's right. Analysts really saying it is such a close call. We had, of course, really a raft of data, some of which was conflicting in terms of pointing to the signalling from the Fed. That August retail sales data on Tuesday, of course, is one of the last ones, and that could potentially still sort of alter expectations, right? Until last week, when we had sort of heard quotes from former Fed officials through the media making the case for a bigger move, traders had all but ruled out a rate cut that's larger than 25 basis points. We also heard from Bill Dudley, of course, the former New York Fed president, a Bloomberg opinion columnist, speaking on Monday. He chimed in favour of a half-point rate cut. So it feels like whatever we get, there is going to be a significant part of this market that's caught sort of by surprise, or at least a disappointment. Our next guest, though, expects the 25 basis point move from the Fed and for markets to be disappointed. Jim Bailio, who's a portfolio manager at Tribeca Investment Partners, joins us now. So plenty of arguments on either side, but, you know, including that if they're going to go big, they should go big now. Why do you think they are on the side of being more conservative?
Look, I think at this point, you know, if they do go big, say the 50 basis point, it actually sends a negative signal to the market, because so far, yes, as you said, the data is conflicted. It is slowing, but not as bad. It's not that bad. So for them to go, you know, quite strong with a 50 basis point cut, it does worry investors. Is there something we don't know? We've seen it before. You know, investor will jump the gun and really will be, you know, taking the risk off. So I think my call is base case scenario is 25 basis point cut. Any more than that, that will be a little bit worrying for investors.
And you do expect a disappointing reaction, though, from the market?
Oh, look, I think with 25 basis point cut, it's more or less in line with expectations. So should we see the 50, then the market will be quite disappointed. At this point, I think, you know, market is expecting quite a number of rate cuts over the next 18 months. And I think that's reasonably expected. They just at this point, you know, market is really, you know, a little bit nervous about the data points.
Are you looking at US stocks at the moment for opportunity, or are you better off sort of looking at, you know, some of the other areas? And we do want to get to China at some point too. too.
Look, absolutely. So with the US stocks, so the problem is quite concentrated, right? So, you know, your tech companies has been such a big winner. Yes, they've been selling off a little bit somewhat, but in this, you know, at the point of the rate cuts, you really want to be looking at some of the cyclicals. And yet at the moment, some of the cyclical data, rebound data is looking a little bit soft, particularly when you talk to China, particularly weak. So, you know, it is an interesting time to be looking at the market, still on the point of, I guess, you know, a bit more defensive and waiting for the pullback opportunities.
I mean, we've talked about that rotation towards cyclicals, towards value, and yet when we see a rebound, it doesn't seem to be sustained at this point. Could we expect a change perhaps in other markets other than the U.S., especially away from the China story? Are there some insulated pockets of opportunities out there?
Look, absolutely. I think, you know, the other markets certainly look a lot cheaper. You know, if I take, for example, the Australian market, you know, it's actually quite cyclical market. It's done well, but, you know, obviously not as expensive as the NASDAQ and the like. And then we also have a bit of a defensive way to play, you know, should the China rebound. You know, the commodity complex is pretty much at its lowest point and looking, you know, very, very attractive. Talking about the value, you know, we see a lot of value and there's a lot of yield in this market as well. You know, and outside China, I think, you know, emerging market, if you look at India and Japan, continue to look very attractive. You know, they are expensive. I think, you know, at the verge of this, you know, the rate cuts, you know, we will see a lot more capital flow into the rest of the world than the US, just the US market.
Do the calculations change for the Japanese market if we continue to see a strengthening Japanese yen because of narrowing rate differentials? Do the sectors that you like change at all at this point, or is there just fundamental value in the overall market?
Yeah, look, at the Asia Pac is always interesting, you know, so these markets will benefit from, particularly the Japanese market will benefit from the continued weakness in the China market, and same as the Indian market. You know, Japanese market actually under the hood, you know, if you look through a lot of mid-cap space, they are going through quite a lot of structural changes, and there's a lot of interesting companies and sectors, but clearly the currency has created a bit of volatility in that market, and then as investors, we kind of, you know, love the volatility and you know, ready to deploy capital. You know, the China, I guess, you know, Chinese market we talked about before, the valuation is extremely attractive. The challenge is that we just don't have that big stimulus package coming through to really reignite the confidence, if you like. You know, it is really the consumer confidence, corporate confidence, really holding back the spending power, and then we've still yet to see that to be revived.
Do you worry about the GDP target being missed, and do you expect, given the data, especially over the weekend, continues to show even worse deterioration than braced for, do you expect more stimulus?
Look, it's almost at this point, the worse the data gets, the more likely that we will have to see the stimulus. If you actually look at the last 2 years, despite the Chinese government stepping up, talking about all the different targeted stimulus, the financial condition actually has been tightening. So, you know, so in our view that, you know, the government actually have repaired its balance sheet in the period of when its, you know, its economy actually required quite a lot of stimulus to really revive it. So, you know, I do think it's getting closer, but at which point, when it is, it's a little bit harder.
Jimbo, before we let you go, I wanted to get our very topical question of the day for the MLive blog, which is looking at the range of assets that could see a reaction depending on what we get from the Fed. So this is asking which assets are most sensitive for the size of the cut, 25 or 50. We have seen, of course, those bets swell towards, you know, closer towards 50. What do you think is sort of, you know, the assets that are going to react the most to avoid and perhaps to take a closer look at?
I actually think if it's a 50 cut, I actually think it's quite risky for the market. You will actually see the cyclical, a bit of weakness across the selling, across the cyclicals. But to me, these are buying opportunities because, you know, we're entering the rate cycle and, you know, cyclical right now perhaps is probably in the bottom of the earnings cycle. And should the rate cut to come through, then earnings will pick up. So I do think it's a great buying opportunity for them. But immediate reaction is they will be sold off simply because, you know, people are a bit worried about data is a bit worse.
Jumbo, always great to have you with us. Portfolio Manager at Tribeca Investment Partners, Jumbo Leo here in Sydney. Coming up on the Asia Trade, the Vice Chair for the Nyse Group will be with us to share their thoughts on the IPO market. We'll also be speaking to Lombard Odier to talk about their Fed cut bets. Plus, looking into Australia's move to impose new age limits on social media with the Queensland University of Technology. This is Bloomberg.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25-50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
You're watching the Asia Trade. One of the morning calls of note today, Goldman's trading desk says there's too much AI pessimism and it's time to buy the dip. The bank sees AI companies' earnings doubling in the next 12 months with lower interest rates on the way and fundamentals remaining strong. AI-related stocks have taken a beating recently, with 3 of Goldman's AI-related baskets trailing their year-to-date highs. And talking about investing in AI, Intel is a watch in late trade after the chipmaker landed Amazon's AWS as a customer. The companies will co-invest in AI semiconductors in a multi-billion-dollar deal. Let's discuss with our tech reporter Annabelle Drewlers in Hong Kong. Belle, so what else do we know about this partnership?
Well, as you can imagine, it's a really big deal and a big win for Intel in particular, because we know that the CEO, Pat Gelsinger, has been on a very ambitious turnaround path or program for the company. But that has been a real challenge because it's struggled with growth. The stock has slumped around 60% just this year alone. It's slashed jobs, had to scale back plans. But getting AWS here is a real vote of confidence, particularly for that foundry business in particular, which of course makes it a contract manufacturer for semiconductors. But AWS is the largest provider of cloud computing. It has been using Intel processors at different points over the years, but now it's shifting more to in-house designs, and that's what it wants Intel to help build now. So what exactly has been decided? Well, this is a statement you're seeing here that was issued by Intel and AWS together, and essentially they're saying it's a multi-billion-dollar deal. It's also multi-year, and the push is going to be to invest in custom AI chips, and they rely on Intel's proprietary semiconductor technology.
But you said it right. I mean, Intel's turnaround drive has been going on for years, and it's also making more changes to their foundry operations.
Yeah, so the shift here is to sort of further separate away IFS, that's the foundry business at Intel. And yeah, we've just had 3 days of board meetings last week going through these different processes or different proposals to try, again, turn around Intel, the business. So what they're going to do with IFS is to further separate them, as I said, from the rest of the company and then become a wholly owned subsidiary. So that idea is to try and make customers or prospective customers, probably more to the point, but some of those who compete already with Intel, to make them see that Intel really is an independent supplier. And now, foundry operations, another win as well, intraday for Intel, because they announced that they're eligible for as much as $3 billion in US government funding to manufacture chips for the military. So that is something else that really helped the shares intraday, because they rose around 6% in regular trading.
And Belle, I guess really setting priorities also means scaling back elsewhere. What are we looking at right now?
Yeah, so Intel did have some really ambitious global expansion plans, and to your point, those have been scaled back. We had, for instance, this announcement around the Germany plan in particular, but also Poland. Those both are going to be paused for about 2 years and then depend a little bit on market demand for its products or its services. Another one in Malaysia, for instance, that's also going to be completed, but it's only going to be put into operation when conditions support it. Again, as you say, it's really that focus on the turnaround plan, getting those back on track for Pat Gelsinger, and really those efforts from the CEO depend on being able to transform Intel into a major foundry that can compete and be considered in the same realm with the likes of TSMC.
There in Hong Kong. Let's take a look at some of the stories that we're tracking on the corporate front. Amazon CEO Andy Jassy is moving to streamline the world's largest online retailer and cloud computing company. The company is cutting management layers and ordering employees to return to the office 5 days a week beginning in January. Jassy announced this shake-up in a memo to employees on Monday and says Amazon wants to operate like the world's largest startup. Microsoft has unveiled a new $60 billion stock buyback program, matching its largest ever repurchase authorization. Microsoft says shareholders will also receive a quarterly dividend of 83 cents a share, compared with the current 75 cents from November. The share repurchase agreement replaces the buyback program announced in 2021. Workers at Australia's largest sugar producer, Wilmar, have accepted a new pay agreement proposed by the company. The deal will end strikes which have occurred occasionally since May. There were concerns the industrial action, along with bad weather, could delay this season's harvest. Australia is the third largest exporter of raw sugar, with over 80% of its output shipped overseas. Boeing is freezing hiring to preserve cash as the plane maker prepares for a drawn-out strike by workers. The firm is also implementing a range of cost-cutting measures, including temporary furloughs and cutting supplier spending. Workers had earlier rejected a proposal that would have boosted wages by 25% over 4 years. Lazard CEO Peter Orszag says young Wall Street bankers are willing to put in long hours if the work is stimulating enough. Speaking with David Rubenstein, Orszag says this includes opportunities such as working on high-profile deals. He also says companies need to be flexible as part of a trade-off.
You're working on important things. It's not just make work. And I think if you put all of those elements together, there are many, many people who would rather work, whatever number of hours per week on interesting, important things rather than fewer hours on things that are not that interesting. And that's what we're looking for. That's the trade-off.
For David Rubenstein's full interview with Lazard CEO Peter Orszag, watch Peer-to-Peer Conversations. That's on October 30th, right here on Bloomberg TV at those times on your screen. More ahead on the Asia Trade. This is Bloomberg.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
Dudley, Bloomberg opinion columnist and Bloomberg economic senior advisor. They're just one of the voices prominent and, of course, across the markets that are either arguing for a 25 basis point move from the Fed or that they should go big and go big now. This is a sort of split. We're seeing so much uncertainty when it comes to expectations across markets. At the moment, we're seeing Sydney futures looking actually pretty positive, about 0.7% there. The rest of Asian markets looking like we could see some volatilities. It was a mixed session on Wall Street where traders really boosted those bets towards 0.5 point. Singapore Nikkei futures actually looking a little bit to the upside, 0.9%. But of course, Tokyo stocks were closed on Monday. Hong Kong also seemed to be slipping. And as I said, some upside there in Sydney. S&P futures looking flat at the moment. We're also seeing potential moves when it comes to Australian government bonds, looking like we'll spend the day tracking global peers higher on this Fed speculation. We're also seeing a little bit of risk on hold of those gains seen in the Aussie as well. That softer US dollar at play today. This is Bloomberg.
Take a look at how U.S. futures are trading at the moment. We saw slight gains in the overnight session. The S&P 500 edged slightly higher, but take away the mega cap tech names and you actually saw it touch a record high. It was really about that outperformance that we saw in the banking sector. Of course, there are lots of bets on a soft landing as we head towards the Federal Reserve decision this week. An expectation, of course, is for the easing to get started. And it's been really that optimism that has sent stocks higher and higher in the U.S. The pace of U.S. IPOs also jumping to $32 billion so far this year, more than double in 2023. But the volume this year is still a fraction of what we saw back in 2021. And that was, of course, before the Fed's rate hikes. Our next guest says the IPO pipeline remains healthy, but the market's return has slowed down a bit. Joining us from Singapore is Michael Harris, Vice Chair and Global Head of Capital Markets at the New York Stock Exchange Group. It's great to have you with us. Thank you so much for joining us after a long flight from New York. But tell us, what will it take, do you think, for the IPO market to really return in a sustainable way? Could we see that after the Fed starts cutting rates?
Well, first of all, thanks for having me. It was indeed a long flight, but it's always great to be back in Singapore. I guess it's really important to start with just from a context perspective of just where the market is. You mentioned earlier that we were basically at a run rate of about 2x versus where we were last year. And I think to put it in context, if you look at the period between, call it, 2014 to 2019, kind of leaving out the height of the boom period in 2020, 2021, we're actually on pace for kind of a typical period in terms of issuance volume. I think when you look at where most issuers are focused on, you're seeing a lot of activity in our pipeline that's looking towards first half of next year. There are going to be some select issuers that are going to look at the September and October time period in terms of issuance activity, but there's a lot that's also causing volatility in the marketplace, most notably the August volatility time period and also the election that's coming up. So it's a much tighter window of issuance that issuers are looking at.
Are those concerns right now that the companies are expressing to you?
I think it's a combination of things. On one hand, you have a lot of companies that are just really focused on looking at their overall earnings picture, looking at trying to make sure that when they do approach the marketplace, there's going to be a receptive environment. Issuers, and rather investors, are very interested in trying to get money to go to work. As you mentioned earlier, from a valuation perspective, U.S. markets are in a very good place. You're seeing issuance activity in the IPO market that's obviously done very well. But not just within IPOs. The follow-on market is up about 20% relative to last year. Convertible issuance is up about 50% relative to last year. High yield, leveraged loans. There's a lot of money that's being put to work, and people are actually looking at generating decent alpha this year as well. So from an investor perspective, people are ready to go. Issuers, you're seeing some issuers that are looking at getting ready. Obviously, we're in the post-Labor Day period in the U.S., so you're seeing some companies that are starting to put their plans in place in terms of getting onto the road and getting their roadshows started. So we do see, as you move into the October time period, a number of issuers that are likely going to be into the U.S. markets. But there is going to be a large backlog that we see coming into the first half of 2025.
Are they ready to go in Asia? I mean, you're in Singapore. I'm wondering how you're planning to attract companies and more interest in this part of the world. Is the trend still towards to have dual listings?
Yeah, it's a great point. If you look at the overall issuance environment, there's been roughly about 40% of companies that have come to the U.S. markets have actually been from domiciled outside of the U.S. We think that trend is going to continue. Asia specifically, there are a number of companies that we've been in dialogue with that are interested in accessing the U.S. markets. There is a bit of a lag effect in terms of where they are in their own timelines relative to U.S. issuers, but we do see a pretty healthy pipeline of activity going over the next 18 months. So we're pretty positive. We spend a lot of time in Singapore. We have a number of people that are actually based in Singapore. Our company, ICE, Intercontinental Exchange Group, has a fairly large presence here on the ground in Singapore. So we spend a lot of time both here in Singapore, also in Hong Kong, and also in China on the mainland as well, talking to issuers throughout all of Asia in terms of opportunities to access capital in the U.S. markets.
I'm glad you bring up China. I do wonder how that sort of environment and just conversations that you're having when it comes to clients and companies in China, given the extra regulatory scrutiny, the raft of delistings. Do you expect that the upcoming election result is going to have a further impact on that?
Yeah, it's tough to say where that's going to end up. You know, I think for most companies, as they look at managing that, they're still really focused on trying to manage their overall business, dialoguing with investors to get a sense of what the appetite ultimately is going to be for them to take risk positions in an IPO. There have been a few issuers that have come to the market successfully, Zeekr being a great example of that earlier in the year. And I do think that for select companies and select industries, there's still going to be a viable investor base among U.S. investors for those companies. But by no means is it the same environment that we saw in 2020 or 2021. Risk appetites have changed, but generally speaking, when you look at U.S. investors, there is a clearing price for almost all risk assets. There is an interest in being able to get diversification. And for the right stories, there is definitely an interest in terms of being able to put money to work, both in Southeast Asia and also in China as well.
So given the uncertainty right now, are we talking about companies that are larger, more established, really looking to IPO, or are we talking about perhaps the AI exuberance translating to more AI startups and smaller companies?
Yeah, it's interesting. You really can't have a conversation with any company in almost any sector now without AI being a dominant theme. But I think if you look at the overall environment this year and what we're generally seeing in terms of the pipeline, larger, more established issuers are the ones that have really been the focal point in terms of the IPO market. And as you're seeing, on one hand, that generally translates into a higher number from a revenue perspective in terms of growth. You're looking at also companies that have a much more definitive timeline in terms of profitability. And at the same time, there's also much more focus on terms of just sustainability of growth over the long haul. And so the differentiation, I think, that you're seeing among U.S. investors is slightly different than we would have seen 5 years ago, where there was a focus on growth at all costs. There is much more of a finely tuned focus in terms of looking at companies that have much more of a sustained growth, but also at the same time visibility in terms of profitability over the course of the next, call it, year to 18 months out from the IPO event.
Michael, it also feels like there are new exchanges, new trading venues sprouting up all over the place, particularly in this part of the world. How do you view competition and the sort of need to stay ahead of the game?
Yeah. Well, look, the New York Stock Exchange has always been the gold standard from an issuance perspective, both in the U.S., but more importantly, globally. So we really look at the competition in a number of different lenses. If you look at what exchanges offer to issuers, it really falls in a few different buckets. So one is from the standpoint of trading and being able to make sure that from an investor standpoint, from an issuer standpoint, you're offering investors the best environment for them to be able to meet one another and provide liquidity. The New York Stock Exchange has a very unique trading model that allows issuers to have lower volatility and also tighter trading spreads. And that's good not only for them, but also for investors as a whole. The other element is also just the visibility that's offered from the IPO event. And the visibility on the New York Stock Exchange is really second to none. We have one of the largest social media following platforms in the world. And for a lot of issuers that are looking to, especially cross-border issuers that are looking to establish their brand in a new community, it's a fantastic environment to be able to do so. We also compete in terms of our IR trading tools and services. We partner with the leading providers that offer those tools and services, companies like S&P and Diligent, many of them that are actually already partnering with private companies to begin with. And then the last part is really the community. If you kind of think about the community of companies that are represented by the New York Stock Exchange, they're the largest brands in the world. They also tend to be the largest companies as well. The median company that trades on the New York Stock Exchange is about 17 times larger than our nearest U.S. competitor. So for companies that are looking to establish themselves with a very large community of relevant brand companies. It's one of those rare opportunities to be able to be on the world stage with the most relevant brands in the world.
Michael, really great to speak with you, and I hope the jet lag gets a little bit better on this trip. Michael Harris, Vice Chair at the Nyse Group. You can watch us live and see our past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. It is for Bloomberg subscribers only. Do check it out. It is at TV Go. This is Bloomberg.
Take a look at how currencies are trading at the moment. Of course, we saw the dollar continue to fall. We're talking about the lowest level since January as Treasury yields continue to push lower. The rally really getting another boost given expectations that the Fed could cut rates by potentially 50 basis points. Of course, that toss-up between 25 or 50 basis points this week is the big question. So two-year yields are now near the lowest since September of 2022, and that has pressured the dollar. On the other side of the trade, we have seen strength for the Japanese yen. Right now, we're seeing giving back some of those gains, but take a look at that. We're still below that 141 level. At one point on the Monday session, we actually touched that 139 level. The offshore yuan not really doing much at the moment, but of course, we continue to watch where the euro is trading as well, because we do have the BOE rate decision. No change expected there. No change expected from the BOJ. It's mostly the Fed that will be watching that potential cut of 25 or 50 basis points. Barclays now saying that any efforts by a second Donald Trump administration to intentionally weaken the dollar could face tall hurdles. Trump earlier told Bloomberg Businessweek that a strong dollar was a tremendous burden. The bank strategists say capturing the Fed and intervening unilaterally are, quote, too costly to be plausible. They say fiscal tightening may be the first best way, but a politically unpopular option. Separately, Barclays sees Trump's proposed 10% universal tariff supporting the greenback by as much as 3 to 4%. Our senior Washington correspondent Aleesha Mohsin joins us now to make sense of the presidential candidate's economic agenda. So, Aleesha, good to have you with us. Just give us a sense of what former President Trump is trying to do when it comes to applying these extra duties on countries that try to abandon the dollar.
Well, the de-dollarization effort that the BRICS Plus economies have launched has captured Trump's attention. Since March, he's been making some comments about how if he was president or when he is president, countries will not leave the dollar, and that it would be really bad for the U.S. and the world if they left the dollar. So now, as we're seeing his plans kind of come out of how he would deal with different adversaries and allies, he has started to say that maybe economic sanctions need to be used more judiciously. That was his word. And maybe tariffs are something that he could turn to with more force. And he also said just about a week ago that if countries want to move away from the dollar or abandon it in any way, as the BRICS summit is supposed to plan out next month, then he would apply 100% tariffs on that country.
Do we know enough about Kamala Harris or Donald Trump's economic plans for markets to sort of be able to adequately predict a Trump trade? I guess we have a better idea of what Trump trade 2.0 might look like, or, you know, how the bonds play might work out as well.
Yeah, coming from Washington, we're all used to the fact that it's not until September of an election cycle that markets really start paying attention to a presidential campaign. And this year is different. Harris stepped in kind of late. She's only been on the campaign trail for a few weeks, and she's got a few more weeks to go. We don't know a lot about Harris's economic policy agenda. We know somewhat about Trump's. We also know that he tends to shoot from the hip and make a lot of changes along the way. So it's a little bit hard and maybe too soon for markets to fully price in and be able to judge where to invest depending on which candidate comes in. But I will say that there are overlaps between the two candidates. They are both vying to show America that we are economic populists. So that's one thing that the world should be ready for, that the U.S.'s bid for protectionism is here to stay.
At this point, do we have any indications of whether the two candidates have any economic plans in common?
Yeah, they have a couple of ideas. Tariffs, Trump would probably be a little bit more, would have amped up rhetoric around tariffs, but the Biden-Harris administration has kept Trump's tariffs on because there's a lot of will from Congress to keep up the protectionism drumbeat. And so a potential Harris-Walz administration, if she becomes president, she may keep those tariffs on, but she has said pretty much nothing on U.S.-China policy and what she would do with those tariffs. But we do know that the tax cuts from 2017 will expire in 2025, so a tax cut is also probably coming, or at least a tax fight. Also, investors need to be aware of where Congress may land. A divided Congress tends to lead to more gridlock, which maybe is a little bit more stable for investors who tend to want predictability, and gridlock can be that form of predictability for them.
Saleha Mohsin, our senior Washington correspondent there. And Saleha is actually the author of Paper Soldiers, How the Weaponization of the Dollar Changed the World Order. The Chinese and Korean translations of her book will be released this month, so you don't want to miss it. And of course, the 25 basis points or 50 basis points debate continues, and Bloomberg opinion columnist and former New York Fed President Bill Dudley sees a strong case for a 50 basis point Fed cut this week. He believes a more aggressive approach will help the central bank align its projections with market expectations.
I think what happened was last week we got two articles, one in the Wall Street Journal, the other in the Financial Times, that basically said the issue of 25 versus 50 basis points is open. And basically the people in those articles, including myself and one of them, basically made the case that the logic for 50 basis points was pretty compelling. And I think as people have reflected on that, and the Fed hasn't pushed back against the change in expectations, the market has come to the view that 50 basis points at this meeting is in fact appropriate. I think what happened was that Powell, thought about it a little bit more and decided that the deterioration that we've seen in the labor market over the last few months means that the downside risks of the labor market probably outweigh the upside risks to inflation at a time that monetary policy is tight. So it's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
I was fascinated by your column and the point you make about maximum sustainable unemployment. I always hear maximum employment, and it's great to see the sustainable in there, because it seems to me 4.2% is a lot more sustainable than 3.4%. Do you really want to push back towards those incredible lows?
No, I don't think so. I mean, I think the Fed in their summary of economic projections we're going to set this week basically thinks that full employment is around 4%. By that, I mean, at 4% unemployment, you're not going to get upward pressure on inflation or downward pressure on inflation. You could just sit there. So right now we're running at an unemployment rate a little bit above that, which just reinforces the Fed's view that the downward pressure on inflation is going to persist.
Why, Bill, are you not more concerned about inflation itself? With the November election just around the corner as well, and two presidents that may introduce policies that could be inflationary, why would 50 be the right thing to do now with the labor market in sight and lesser worries here about the reacceleration or at least sticky inflation?
I think it's because the Fed takes the world as it is and doesn't speculate about what's going to happen in the future, or who's going to win the election, what policies set they're actually going to get. That's going to take, quite a few months to play out. I mean, the new president won't be coming in until late January. So I think the Fed's view is we got to set policy based on what we see today, what we see on the risks of inflation versus the labor market. And, if the policies that are pursued by the next president turn out to be inflationary, then the Fed will adjust policy appropriately at that time.
Bloomberg opinion columnist and former New York Fed President Bill Dudley there, speaking with Bloomberg's Matthew Miller and Sonali Basak. More ahead on the Asia Trade. This is Bloomberg. Take a look at how we're shaping up as we get into this Tuesday session. Of course, so much heightened volatility expected from that Fed decision because of just the heightened nature of some of the confusion over whether it is going to be 25 basis points or 50. We're seeing those market bets in the last sort of few trading sessions just moving closer towards 50. At the moment, we're seeing some outperformance expected when it comes to Sydney stocks when they come online in about 7 minutes' time, but potentially some weakness elsewhere. We're also seeing the likes of Tokyo potentially seeing volatility after that holiday session on Monday. When it comes to currencies, interestingly, the Aussie dollar is actually holding on to some of those risk-on gains as we have a Bloomberg gauge of the dollar sinking to its lowest since January. It paired some of those losses up, but still quite a few swings. And certainly, Shery will be watching for trading in the yen after it rallied beyond that pivotal 140 level against the greenback.
Yeah, it's really a function of what the dollar is doing, right? Because as you mentioned, on the other side of the trade, you had the dollar at those January lows. And what's propelled that? Of course, Treasury yields. They continue to fall. So we're talking about the 2-year yield now at the lowest level since September of 2022. Expectations now that the Fed could be headed towards a potential 50 basis point cut. That bet really returning to the markets. And when we got the payrolls data, which sort of disappointed in a way, we actually had traders thinking that perhaps a 50 basis point cut had gone out the window. Then we had rhetoric coming out last week from Midea reports that the Fed was still considering a potential 50 or 25 basis point cut. So that's back on the table. So you have the 10-year yield also declining to that 360 level. So we continue to watch the sovereign bond markets across Asia because the 10-year JGB yield has also been pressured, and we're talking about it being below that 90 basis points level. And this all coming at a time when the BOJ is supposed to go in the opposite direction at some point later in the year. Perhaps not this week. All economists don't expect the BOJ to move this week, but they are forecasting a potential move towards a rate hike in December. And really that leading to the Japanese yen strength. Not a lot of strength for today's session, but in the overnight session, we actually saw it touch that 139 level. We're talking about levels that we haven't seen since 2023, Haidi. So HSBC now raising its forecast for the yen as well.
So much expectation and, you know, sort of that direction will really come from what we get from the Fed, right? We're hearing from President Biden's top economic advisor, Lael Brainard. Of course, we have heard from her quite often, but she's now saying, really downplaying that inflation risk, saying the lower rate situation aids the housing part of the picture, but that the US economy has reached that turning point. So just another one of these voices that we're hearing from as we get into that Fed decision. Will it be 25 or 50? And what assets do we potentially see seeing that outsized reaction? Of course, treasuries and the dollar in focus. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. After we saw some gains on Wall Street, Haidi, we're seeing the rotation continue away from tech mega caps, perhaps into some cyclicals on expectations of the Fed cutting rates this week.
And just a surging uncertainty, right? Markets really split between, do we get that jumbo-sized 50 basis point cut? Do we get a more conservative 25? The bets have really been all over the place, but really kind of heading more towards the larger sized cut. But of course, this has big implications when it comes to what goes on here in Asia, including how much further does this yen rally continue to go?
Yeah, I mean, we haven't seen that much uncertainty when it comes to Fed rate decisions in years in the swap markets. And that's now leading to the Japanese yen also to strengthen. Interestingly, HSBC now raising the forecast for the Japanese yen, saying that it's again starting to act as a safe haven asset. Remember when it continued to weaken against the US dollar, despite the fact that we continue to see volatility around the world. Right now, we're seeing a little bit of downside pressure against the US dollar in the Asian session, but only after after it touched that 139 level overnight. Really a lot to do with the function of where the dollar is headed. We're seeing incredible weakness as Treasury yields also continue to fall. The 2-year yield at the lowest level since 2022. The Nikkei, the topics coming back online after a long weekend. We had a holiday in Japan. We're seeing a little bit of upside, perhaps some catching up to some of the gains that we saw globally. We had gains in the Australian session as well overnight on Wall Street. So we're rebounding from some of those losses that we saw on the Friday session. The 10-year yield, though, continuing to be under that 0.9% level. Of course, we are headed towards the BOJ rate decision, Haidi. Not really expecting anything when it comes to the BOJ, but more than half of economists now expect a rate hike in December.
Take a look, Shery, at what we're seeing when it comes to trading just getting underway in Australia. And it is that staggered session, of course, but we are expecting to see a little bit of upside today when it comes to trading in Aussie stocks, at least about 0.1% is where we're starting off the session this morning in the first couple of minutes. The Aussie dollar has been kind of clinging on to most of those risk-on gains. 67.52, of course, we did have the fall in the US dollar and that Bloomberg dollar gauge dropping to the lowest since January. It's since sort of come back some of those lows, but certainly that trend of dollar weakness is what we're watching as we head into that rate decision. We are seeing a potential when it comes to perhaps a recovery for some of those mining names that have been hit by the weakness in China as well. We are seeing that sort of fresh record high, pretty close for Aussie equities. It is really those financials and some of the property stocks have been lifting that benchmark there. Watching treasuries, of course, as these yields continue to really just fall lower, and we are seeing that that being reflected in the start of trading when it comes to Kiwi and Australian treasuries as well. The risks, particularly when it comes to the short term, the US 2-year yield potentially pointing a little bit higher there, Shery.
Heidi, our next guest trimmed their position on the U.S. dollar from overweight to neutral due to the narrowing rate differentials. With us now is Homin, senior macro strategist at Lombard Odier. Homin, always good to have you with us. It's really interesting that the markets are now pricing in a potential 50 basis point cut from the Fed, right? But what happens if they actually disappoint? Will we just continue to see this sharp volatility and perhaps even the yen strengthening much more?
Well, we do think the Fed will go ahead with the 50 basis point cut in the upcoming FOMC, and to the extent that this signals the start of a pretty substantial easing cycle, not all the way down to zero rate, because we don't have a recession, but still that's 150 to 200 basis point of cuts in the U.S. that makes the currency less attractive. So that's going to have a push impact on global investors toward assets outside the U.S., and we would count the yen and the Japanese assets as part of that trend. But if the Fed somehow disappoints in the upcoming FOMC, we'd say 25 basis point cut, it will simply signal that what the markets are pricing. Right now as we speak, I've just seen the Bloomberg screen before this interview, and it looks like the markets are already going overboard with almost 125 basis point cut before the end of the year. So if they disappoint in that regard, there'll definitely be a bout of volatility for the markets because they have to reassess the trajectory they have been expecting before the meeting. So we don't think that's likely. We think the right risk management move for the Fed is to start with a 50 basis point cut, and because it confirms the what's seen as appropriate for the U.S. economy, that will probably have a calming effect for the markets.
Could it go the other way around, where it would also confirm that the economy in the U.S. is not really doing that well? Some of the comments that I get from analysts is that it could actually worsen the panic.
So if you look at the latest, initial jobless claims number in the U.S. and also consumption numbers, we're going to get another update for the retail sales, and we expect that to confirm a pretty decent growth for consumption segment in the U.S. economy. So if you take all these indicators together, they don't point to an ongoing recession. Now, for the job market, it is true that the unemployment rate in the U.S. Has risen a little more than the other developed markets so far. Now, part of this could be due to weaker demand. Yes, we're seeing that in the job postings and et cetera. But also it could be due to a better supply side performance by the U.S. Productivity trend has been slightly better. And also there has been an infusion of workers into the labor force. So our view is that, at the end of the day, supply side performance seems decent enough. However, with the Fed, changing the focus to the employment mandate, this is simply a risk management move. So we don't think there's a recession that's going on. For that reason, this is not going to be a panic response for sure. So the 50 basis point is probably the farthest they can go for the September FOMC.
It's really a double-edged sword, right? It feels like whatever they do, there's going to be disappointment on either side. But, Homin, I do wonder, when you take a look at the assets that are most sensitive to perhaps a move in volatility, depending on that decision, and this is our MLive blog question of the day, which assets are most sensitive to the size of that Fed rate cut? What are you looking at here?
So assuming that the Fed delivers a 50 basis point cut, obviously the currency markets will respond pretty positively because, again, it will confirm the start of a pretty meaningful easing cycle in the U.S., with a focus on the labor market performance. So, if that's the case, then certainly the other currencies, for which the easing cycle might not be as aggressive, will start performing better. So yen, in particular, for next 12 months, we think it's going to benefit from this narrowing interest rate gap between U.S. and Japan, but also some of the Asian currencies and emerging market currencies, in places such as Brazil, for instance, where the rates actually will be raised, in our expectation in the next 12 months. These currencies will start benefiting more significantly as we head into 2025. Of course, there is the issue of U.S. election. So the investors will not be extremely aggressive right from the start, but at least it's a nice backdrop to have this easing cycle in the U.S.
You don't think short-term rates will go beyond 1% in Japan, so you think the BOJ perhaps will actually be more conservative than what perhaps the markets, or certainly currency markets, have in mind at the moment?
So we are aware of the recent comments by board member Takata, and also if you think about the July press conference by Governor Ueda after the monetary policy meeting, he specifically pushed back against the idea that 0.5% is the ceiling of the Bank of Japan's tightening exercise. Now, we think it makes sense for the Bank of Japan officials to keep that optionality, so that they could lean against the market if the yen depreciates too much for some unexpected reason. So it makes sense to keep this option. At the same time, once Bank of Japan start raising rates above 0.5%, they start incurring negative carry on their entire balance sheet. And we're not talking about an economy that, for which the underlying growth is 2 or 3%. The best you can hope for is maybe 1 or 1.5% in the medium term, with the inflation expectation settling at 1.5. So our guess is the Bank of Japan will proceed a little more carefully than what some of the market participants are expecting. So our base case is that 25 basis point hike in December will likely be the last hike by the BOJ. Of course, the data and the Trade Confederation guidance for the next year's Shunto negotiation will be a key variables in this regard, and also the U.S. election outcome.
And Homin, we do have, of course, another closely watched decision, which is the BOE. Not really any change expected there, but you're actually overweighting UK equities right now. And interestingly, you're trimming your India overweight as well. So can you tell us what is behind these two calls?
For the UK equities, we've been maintaining a bit of overweight for quite some time now. It's an economy where GDP growth is actually improving, so the economic outlook is improving. And if you look at the consensus earnings numbers, we're going to see a pretty meaningful jump in earnings growth next year, and that's a pretty nice setup for the for the country and the market. It's one of the cheapest in the developed markets, cheaper than Europe and Japan, and it has a bit of cyclicality. So it's a nice value story to have for the developed market equity bucket. Now for India, we're long-term positive on India for sure. It's still going to be one of the fastest growing economies within the emerging market space. But the valuation is now becoming less comfortable. Forward PE multiple for the entire MSCI India is above 24.5. And if you think about the near-term earnings outlook, because growth is slowing down a bit, you're going to see probably ceiling for earnings. In fact, forward earnings expectations are now beginning to be marked down because of this. So tactically, we think it makes sense to take a bit of profit here and wait for a better entry point. And that's the reason why we recently trimmed our overweight on India to neutral.
Homin, always great to chat with you. Homin Lee, Senior Macro Strategist at Lombard Odier. Let's take a look at one sector of stocks that we're watching early in the session, and that is really chip makers. This is a picture, as of course we also have Tokyo stocks coming back online after that extended weekend there. Biden there up by just about 2.3%, a little bit of downside for some of the other players, including Tokyo Electron. We had the news, of course, overnight that Intel is set to make a custom AI chip for Amazon. They're also announcing a delay to their plant in Germany, but we did see chip makers, Intel stock jumping after that announcement and some of the sort of efficiency plans and the update on the US factory expansion being on track there as well. But really, the top news is really Intel landing Amazon's AWS as a customer for the manufacturing business. Potentially that brings some of that workflow to new plants that are under construction in the United States and boosting those efforts to turn around Intel's broader business as well. So this custom semiconductor for artificial intelligence computing, a fabric chip in a multi-year, multi-billion-dollar framework. Let's get some more on that partnership. Our tech reporter, Annabelle Drawlers in Hong Kong, is with us. So, Belle, talk us through really the significance of this development.
Well, it certainly is really major news for Intel and exactly the sort of news that the company wants to see as well, the sort of partnership that they can announce to the market. So, as you mentioned, this is a multi-billion-dollar, multi-year deal, and it's going to be about developing or building a custom AI chip. So it's called a fabric chip, or it's focusing on a fabric chip. It's sort of a networking chip, perhaps not the mainstream kind of chip that Intel would be hoping to make billions and billions of dollars on over the coming years. But it really is a start and a big name that's now associated with the foundry of the business. This was just announced earlier. We have seen that big rise in after hours, intraday as well, but it is really that focus on the turnaround plan for the company. Pat Gelsinger's ambitious changes that he's got afoot and how that is being executed now.
And then some of those changes including the foundry operations.
Yeah, so I guess if you're a company like AMD or you're like NVIDIA and you're thinking about, okay, maybe I want to diversify that risk away from just having TSMC as the manufacturer, Intel obviously is pushing its foundry business and it wants to be able to develop those capabilities and that size, but it needs to be able to demonstrate to customers, given that it is also a chip maker, given that it has that sort of separation. And this is what IFS, which is the subsidy operation or the fab operation at Intel, that's going to be even further separated from the rest of the company and now become a wholly owned subsidiary. So again, it's just about trying to convince prospective customers, with, of course, continuing to track the sorts of business that it's managing to gain. And just intraday as well, we had the company announcing that it's eligible for as much as $3 billion in US manufacturing support or government funding to manufacture chips for the military. So again, it's just another win for that foundry business so far.
Elsewhere, though, we're seeing some restructuring and scaling back.
Yeah, so we actually had an interview with the CEO, Pat Gelsinger, earlier talking about this very topic, and essentially the expansion plans that the company had are no longer really supported by the reality that it faces. And so Pat Gelsinger told us that essentially they've just had a close look at what they're doing and preserving their cash for their key focuses, which seems to be building out more of those foundry operations in the US instead. So we do understand that certain projects have been sort of put on ice. So Germany, for instance, Poland, those construction projects are going to be paused for about 2 years and they can reassess the market dynamics. Malaysia as well, there's a fab there, but that's going to be completed. It won't perhaps be fully put into operation until the conditions support it. But it does really come off the heels, or these announcements come off the heels of a 3-day board meeting that's just concluded, and certainly that focus really is on preserving cash right now at the company, given as well we've been discussing all of those challenges that it faces. I mean, the stock's down around 60% this year. They've had to really think about the different projects at the company. They're slashing their headcount as well. A lot of challenges ahead, and this foundry news is just one real positive that it's got now.
Yeah, investors seem to really like it after hours, really that jump of 8%. Annabelle Jewelers there joining us from Hong Kong. We have more ahead on the Asia Trade. This is Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
The former President Donald Trump is looking to capitalise on the second attempt on his life in recent months. Sources tell us that Trump will continue his campaign schedule this week, just 50 days out now from Election Day. Jill, we know that, with these sorts of scenarios, and it's pretty shocking that we've had 2 assassination attempts apparently within the last 2 months, that this tends to kind of galvanise his supporters, right? What do we know about, what's going to happen from now, and any further about the suspect himself?
Sure, Heidi. Well, look, this is still a rapidly developing situation here, right? So at this point, what we do know about the subject, Ryan Routh, he's 58 years old. He's been taken into federal custody, and he currently faces some federal-level gun charges, including possession of a firearm by a convicted felon. We don't really know anything too much about the motives here, and we also don't know what else he may actually be charged with. So at this point, the FBI is holding him in custody. They've got until, I think it's the end of the month before they can actually, potentially present further indictment. I mean, the FBI is describing this as, potential assassination attempt on the former President Donald Trump. So there's additional charges that could be faced there. They have given us some more detail about this person's, social media background. They found some fairly erratic posts on X, the platform formerly known as Twitter, including something, about how he may have been trying to get foreign fighters to go fight in Ukraine. But a lot of this is very erratic, and it's not entirely clear whether there's a clear political motive at play here. That's something that we might have to see just kind of, unfold over the coming days and weeks, particularly as we wait to see whether there's more information that actually comes out about, some of these motivations, or whether that's tied into any additional charges that this person may face.
And yet the former president is already pointing fingers at President Biden and Vice President Harris for what he claims is their rhetoric causing him to be shot at. What exactly is he saying here?
Yes, so the former president is certainly blaming this on campaign rhetoric from the Harris and Walz campaign, from current President Joe Biden, who obviously was on top of the ticket before he stepped down earlier this summer. He didn't really provide any specific examples of that type of rhetoric, and of course, Donald Trump himself has been known, certainly for some inflammatory rhetoric. I believe in his statement he actually kind of acknowledged, he said that he had done that better than the Harris campaign does, or what have you. But yes, it certainly does seem like Donald Trump and his supporters are kind of ratcheting up this idea, that it's rhetoric that's, leading to these, potential assassination attempts. The Harris campaign has not responded to that most recent statement from Donald Trump just yet, but had previously said after this incident took place on Sunday that there was no place for violence in America. We saw some similar comments from President Joe Biden himself. But really here, I think this is just underlining, how divisive aggressive, obviously, this campaign has become, and also just how dangerous some of these things have become. I mean, it was really just 2 months ago that we saw, a potential assassin, target Donald Trump while he was on stage at a rally in Pennsylvania, and obviously in that instance grazed Donald Trump's ear. So just to have this kind of incident happen a couple of months later, even though it appears that the gunman had never, had Donald Trump in his line of sight on this golf course during this incident, just kind of sort of suggests here how dangerous some of these things have really become.
How does this, we mentioned before we're just, 50 days out from Election Day. How does this impact the rest of campaigning, right, in terms of the security measures and how, certain events might be impacted more than others?
Well, so we know that, after the last attempted assassination on Donald Trump back in July, we did see, a considerable fallout facing his Secret Service detail in particular. I mean, the head of the Secret Service resigned after a series of inquiries. It's not clear whether we see any additional measures taken here. The initial response to this incident was actually one where Donald Trump and some others praised the Secret Service's response. They did up his personal Secret Service protection there after that July incident, though it seems like, maybe they'll kind of re-examine measures here, whether they need to take anything additionally. Now, both the Trump and Harris campaigns haven't said that, they would suspend any kind of events or anything like that. We did see in the aftermath of the previous, attempted shooting here that, you saw Donald Trump, kind of perform at rallies with, glass around him, other protective measures. Maybe you see something additional there, but it does seem that both of these campaigns, with, as you said, just about 50 days out before the election, do plan on continuing to hold events, sort of meet with the public, but we'll have to see if there's any additional security that tightens on the back of that.
Our news desk editor Jill Deasy is there. Let's turn to China because economic losses from Typhoon Bebinca could hit 10 billion yuan after it slammed into Shanghai on Monday, the biggest storm to hit the city since 1949. For more, let's bring in our China correspondent Min Lo. So put this into context, Min. How big of a hit would this be to the economy?
So according to our Bloomberg intelligence analysts, they are projecting that this could be the strongest, the costliest storm yet to hit China this year, because even though Bebinca is a weaker storm compared to Typhoon Yagi, which over a week ago landed in the southern Hainan province, Bebinca was headed straight for Shanghai, which is China's economic center. And Shanghai, by the way, rarely gets a direct hit from a typhoon. And it also hit during the Mid-Autumn Festival, which was supposed to be peak travel season. I mean, anytime you have a long weekend like this in Shanghai, if you go to the Bund, it would have been packed shoulder to shoulder with people. But now we know from China's state media that China has already cancelled over 1,600 flights so far. And our Bloomberg intelligence analyst estimates that the total losses could go up to 10 billion yuan. And for context, Typhoon Gamy had cost China about 7.6 billion yuan. 8.6 billion yuan, I'm sorry.
China correspondent Bloomberg's China correspondent Min Lo there. More ahead on the Asia Trade. This is Bloomberg.
And we're getting breaking news out of Singapore. The non-oil domestic export numbers month on month is a contraction of 4.7%, which is much greater than economists had expected. And remember, we've seen this number really fluctuating throughout the year. We're talking about exports contracting for 4 of the past 7 months so far this year. It's another contraction of almost 5% after gains in the double digit from the previous month. Year on year is also a smaller gain of 10.7%. Really, the gains in the export side year on year also slowing down, and it's really slow, much smaller than economists had expected. Electronics exports, though, staying strong in Singapore, growth of 35.1% for the month of August after gains of 16% in the previous month. We have seen a little bit of challenges when it comes to Singapore. Of course, we know that the export value is equal to about 1.5 times the size of Singapore's economy. Right now, the economy expected to grow up to 3% this year, and it's largely hinged on global demand. Again, non-oil domestic exports month-on-month, a contraction of 4.7%, which is much larger than economists had expected. Take a look at how we're trading broadly in the markets right now, because we are seeing the Japanese equity markets really reverse some of those earlier gains, down about 0.6%. Tech and financials leading those losses, not surprising given that in the Wall Street session as well, we had gains slightly for the S&P 500, but the big mega cap tech names have been lagging, and we've seen that rotation away from the tech sector. The ASX 200 gaining 0.3%. This would be a fourth consecutive session of gains, Haidi, and of course, we're following Kiwi stocks down 0.4%.
Yeah, and really one of the stories that we're following is the Auckland Airport share placement. We heard, of course, they wanted to raise 1.4 billion Kiwi dollars for a new domestic terminal to fund that capital investment program. We have seen that update earlier this morning, Auckland Airport saying that that $1.2 billion share program placement was fully subscribed, with placement strongly supported with bids well in excess of that size of that offer. A lot of existing institutional and other select investors, both locally and also from offshore markets as well. So the offer closes on October 4th, so we're keeping an eye on that. But certainly we're looking ahead to that new domestic terminal building, which is really at the core of that $2.2 billion Kiwi dollar, I should say, domestic terminal expansion project. Another story that we're watching when it comes to some M&A sort of murmurings in Australia is Philip King's Regal Partners offering to buy its rival Platinum Asset Management. The hedge fund has been pressing on with this expansion push that's seen them triple assets in just 2 years. The share offer, unsolicited and unbinding, to acquire all of Platinum's shares via a scheme of arrangement. Shareholders for Platinum will receive 0.274 Regal shares for each Platinum share held. That offer is equivalent to 61 US cents, I should say, per share. It is a 10% discount to the Platinum closing price of Monday. We have seen Platinum shares just nosediving around 26% this year. Regal shares, though, have rallied about 24%. We are looking at a big IPO that we've been watching. Chinese appliance giant Midea Group says its Hong Kong listing is 5.31 times subscribed. Trading is set to start on Tuesday. Let's bring in Bloomberg Intelligence senior analyst Ada Lee. So, Ada, it's a pretty robust cash position we're talking about when it comes to Midea. Why does the company need to raise so much cash by going to market?
Absolutely. So Midea's balance sheet has been robust. If you look at it since 2020, its net debt to EBITDA ratio has been consistently below 1 times. And the proceed is intended to be used for global expansion in terms of global R&D, as well as expansion in its distribution channel and sales network. We believe that even though the company has robust cash position in its coffers, the proceeds from the IPO can fuel 3 things. Firstly, it can increase international attention on the company itself from both the investor as well as the consumer. Secondly, the equity offering can offer a medium for the company to provide some equity incentives to its overseas employees. Thirdly, of course, most importantly, we think that it could help Midea to fulfill its international ambition through M&A activities.
When we're talking about global ambitions, isn't it a bit problematic at a time when, of course, we are headed towards the U.S. presidential elections and the trade disputes with China are just intensifying?
Yes. So if you look at Midea's business, it currently has over 40% of its sales outside of China. So it's quite a substantial proportion already in Midea's books. Midea's potential, the listing could actually help with this international expansion. And international expansion-wise, it allows the company to expand its product portfolio, diverse its income stream, and also to reduce reliance on the Chinese business. So if you look at Midea's M&A activities, for the past decade, it has been growing through quite aggressive acquisitions of established brands such as Toshiba, Eureka, and Kuka. So I think, you know what, there's no good time for a deal like this, but today is definitely some good news for the market.
Definitely good news for Hong Kong equity markets, right? How much is this sort of a litmus test in terms of confidence, and how important is it? It's also interesting that a mainland company has chosen Hong Kong rather than, say, Shanghai.
Correct. So I think this is a very good news for the market, and also any company that wanted to list on the Hong Kong Stock Exchange. If you look at this, this is the largest listing on the Hong Kong Stock Exchange this year, and also the second largest globally year to date. And this is just behind the company called Lineage, which listed on the Nasdaq in June this year. So this is a massive IPO, and I think it provides a lot of confidence to the companies to potentially list their company this year. And one company that we are looking for and following closely is China Resources Beverages, which is also looking to IPO this year on the Hong Kong Stock Exchange.
Bloomberg Intelligence Senior Analyst Ada Lee there. And here are some of the other stories that we're tracking on the corporate front. Microsoft has unveiled a new $60 billion stock buyback program, matching its largest ever repurchase authorization. Microsoft says shareholders will also receive a quarterly dividend of 83 cents a share, compared with the current 75 cents from November. The share repurchase agreement replaces the buyback program announced in 2021. Singapore's CapitaLand investment is said to be in advanced talks to buy a minority stake in French luxury resort chain Club Med from its Chinese owner Fosun International. Sources say CapitaLand is looking to acquire up to 30% in the hotelier from several hundred million euros. Bajaj Housing Finance shares more than doubled in India's biggest new listing of the year. The home loan unit of the country's biggest shadow lender posted the biggest first-day gain for a large Indian IPO, over $500 million on record. India's been a global bright spot for capital raising, with stocks gaining more than 30% on average in their debuts this year. We'll be hearing from the Bajaj Housing Finance chairman Sanjeev Bajaj later on Bloomberg Markets Asia, discussing the firm's trading debut and corporate outlook. You can catch that interview at the time listed on your screen. We have more ahead on the Asia Trade. This is Bloomberg.
Well, we're listening to parents and listening to the community. And I want to see kids off their devices and onto the footy fields and the swimming pools and the tennis courts. We want them to have real experiences with real people, because we know that social media is causing social harm. This is a scourge. We know that there is mental health consequences for what many of the young people have had to deal with. The bullying that can occur online, the access to material which causes social harm. And parents are wanting a response.
Australian Prime Minister Anthony Albanese, as the country looks to impose age limits on social media websites. And Canberra is looking to introduce these new laws before an election is due within the next 9 months. Let's bring our Australia Government reporter, Ben Westcott, who joins us now with the latest. So, sparse on details, right? But what are the sort of framework that we're looking at that the government is proposing?
Sure. So the broad laws that the government's planning to impose are age limits on social media between the ages of about 14 and 16. They haven't decided on the exact age they're going to look at this stage. That there's some who are looking at 16. The Prime Minister himself said he favours 14. And actually, it varies across states and territories what they're looking at as well. Now, in terms of how this would work, that is the big question. And the government is already doing a couple of age verification trials to try and restrict access to, sensitive online websites such as pornography for people below the age of 18. They're going to sort of turn that age verification trials into how they'll do this restriction on social media. But how that looks, whether the technology is viable, none of those questions have really been answered yet.
How have social media companies reacted so far?
Well, so far, most have been quite cautious, but the head of the tech entrepreneur Elon Musk, who owns X, formerly known as Twitter, has described the measure as fascist, in particular labelling the Australian government as fascist for imposing this measure. While that's very strong language, it isn't the first clash between the Australian government and Elon Musk. They fought earlier this year over a push by the Australian government to get X to remove some videos of a Sydney-based terrorist attack from social media websites, a fight that eventually made headlines around the world.
Is this the first clash that we've seen between the government and tech giants?
No, not at all. This is really the latest in the series of measures the Australian government has put together since it came to power in May 2022, which have sought to crack down the power of social media companies. And most of this legislation is still sort of either in the process of being pitched, being running its way through Parliament, or being enacted. There's a large suite of measures. As we've mentioned, there's the age verification trials. There's also an intended bill to crack down on misinformation and disinformation on social media, which is also very controversial, particularly among Conservative parties who accuse it of being an attack on free speech. In addition to that, the government has also taken on companies such as Facebook, Meta, and Google over claims that it is ripping off Australian media companies. Meta has refused to continue to pay to use Australian news, and as a result, the government is now considering forcing Meta to pay dividends to Australian media companies, which would just be another front in this war on social media, which clearly the government thinks must be electorally popular. And to be honest, polling so far has shown that their crackdown on teenagers using social media is a popular measure, with almost 60% of the population approving of it.
Australian government reporter Ben Westcott there with the latest. And let's bring in Aleesha Rodriguez, who joins us now. They're a research fellow at the Australian Research Council's Centre of Excellence for the Digital Child at Queensland University of Technology. Aleesha, really great to have you with us. It's interesting, Ben talked about polling and how broadly supportive of concept I think a lot of parents would be on this topic. We're very sort of short on details as to how this would work. Are you suggesting that this would not work and perhaps could be detrimental when it comes to a sort of, I guess, whole of childhood and teenagehood experience for kids?
Yeah, absolutely. So at the Digital Child, we recognise that children are growing up in a digital world, and these kind of knee-jerk responses by the government, which, importantly to say, aren't evidence-based. The age assurance trial is still ongoing. The evidence from that hasn't been reported on. There's also been a joint select committee on social media in Australian society. That also hasn't, the government hasn't produced any findings from that yet. So the Prime Minister's announcement that they're looking at banning children appears to be a knee-jerk reaction, and who loses out in this situation are children and young people who are growing up in a digital world.
The stakes are so very high, though, so you can sort of perhaps not blame policymakers for having this knee-jerk reaction and wanting, even a Band-Aid fix or a quick fix, right? How do you balance out the two sides, right? Because as you state in your research, the internet was not created for minors, for children in mind. So how do you regulate that in a way that, works for younger people?
Yeah, absolutely. So it's really important to frame this as it's a Band-Aid solution to kind of look at banning social media. And just to also really underscore, absolutely, like this is a pressing issue. Understandably, parents are concerned, educators are at a loss, something needs to be done, but excluding children is not the answer, and actually looking towards something such as creating and supporting a children's internet is. And this phrase, the children's internet, is really useful because we can look to things like children's television, which we understand in Australia as a public good. We have government investment to produce high quality children's content, and we also have frameworks frameworks such as the classification system to help parents make informed decisions about what types of things are appropriate for their children to be engaging with at different ages and stages. And so that's the solution that we should be looking towards, is having really nuanced, robust, evidence-based conversations with consultation with children and young people of how do we create internet spaces that are appropriate, enjoyable, and safe for them.
But children's television, for example, is something that you can just switch the channel on. So when it comes to the internet, there's so much content out there. How do you make sure that children actually go to those right types of content that you're talking about and to the children's internet without really having to ban some of the other areas that they could be influenced by?
Yeah, it's a really great question. And this is the important distinction between the children's internet and children's television, is that the children's internet is made up of a really diverse array of products, services, and content that is specifically made for children and things that are not made for children but likely to be accessed. I think a really important thing to highlight is that children don't want to be seeking out things that are not age appropriate. Children want to be going to the spaces where their peers are, where they can have fun, where they can learn, where they can explore, and they can take risks in really safe ways. So the thing is that we need to be creating those spaces that children want to be going towards. And that requires investment and also regulatory frameworks to hold tech companies accountable so that they are making those spaces to be appropriate for children and young people.
I'm not sure that's completely true if you were talking about rebellious teenagers, going into the internet and trying to do things that they're not supposed to be doing. But how would you incentivize private companies to come up with these types of content and try to lure younger people?
Yeah, really great point. And just to point out with this ban as well, this is one of the problematic things about the ban, is that there's a question of what does the government even mean by social media? And if what they mean by social media is the major platforms, it means that children will go and seek out experiences in more low quality, riskier, less moderated spaces, right? So this is why we need to be working towards having these incentivizing these spaces for children to be going to. And I think that part of this important conversation is, as a society, we're putting ourselves in a between a rock and a hard place when we're having these conversations, because on one hand, we understand that children are online, that they are seeking out these experiences, but then on the other, we're very upset towards tech companies and the ways in which they're approaching children's spaces, children's data, children's privacy, right? And so we have to actually come together and work towards having really strong regulatory processes, but also working with tech companies, with consultation, with children, with families, with educators and civil society groups to create meaningful spaces that children want to hang out in.
We've seen before that working with tech companies, by and large, do not prioritise mental health, right? Whether you're talking about adults or children. We know that Meta, for example, through the whistleblower documents back in 2021, knew about the adverse effects on mental health of Instagram, for example, on young girls. They have this research and this knowledge. So I do wonder, when it comes to punitive measures to crack down on this sort of thing, punitive measures to crack down on misinformation, which has led Elon Musk to call Australia, the government fascist. Do you think there's a strong role for that side of things to be played out here?
Yeah, there has to be some type of enforcement. That's the way that it will hold tech companies accountable. But I guess it just has to be one of these things that we're finding ourselves, like I said, between a rock and a hard place. And as this is entering the national conversation, we all understand that something needs to be done. And part of that is we have to work together. Industry, government, civil society groups, educators. We need to have consultations, and we need to come together and start solving this problem in a really robust way, an evidence-based way, and not a knee-jerk reaction.
Aleesha, really great to have you with us. Aleesha Rodriguez, Research Fellow at the Australian Research Council Centre of Excellence for the Digital Child at the Queensland University of Technology. We have more every week on Australia Ahead on the big issues confronting the country and beyond. Tuesdays at 10:40 a.m. in Sydney. This is Bloomberg.
We're seeing some pressure on Japanese equity markets. Of course, we continue to follow the Japanese yen at this year's high around that 140 level. We're hearing from the finance minister Shinichi Suzuki speaking in Tokyo, saying that authorities will be watching the impact of the FX moves on the Japanese economy, on Japanese livelihoods, that the currency is determined by the market and it reflects fundamentals, but that rapid FX moves are undesirable. So the finance minister now saying that the authorities are watching the forex moves very closely. But of course, we continue to also watch another mandate by the finance ministry that has been about the designation of 7NI as part of a core industry here in Japan. We got news last week that the Japanese government did add 7NI to that list of core designated companies. And Shinichi Suzuki now saying that 7NI's new status is really not going to make it more difficult for a takeover. Of course, we have seen that offer by Couche-Tard. The finance minister saying that 7NI's new status as a core company because of national security doesn't necessarily mean higher acquisition hurdles. Of course, Haidi, we know that after Couche-Tard's offer to 7NI, we have seen that reluctance coming, and we continue to see how that unfolds. But for the time being, the government has now designated it as a core company under the Foreign Exchange and Foreign Trade Act, which means that any foreign entity needs to give prior notification if they actually purchase shares of more than 10%.
Yeah, very fair question as to whether this makes this potential acquisition far more difficult, right? This is a picture across what we're seeing when it comes to trading. A bit of bifurcated trade. The Australian stocks advancing, banks, tech shares given a boost there. We're also seeing that swing session for Japan. This is Bloomberg.